Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Also, I'll just let you have a quick look at the disclaimer. I'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll firstly focus on developments in the Middle East, of course, and we'll look at some of the, well, just some thoughts around that situation, around the risk-off environment that we're currently seeing. And we'll look at gold and oil, those commodities most affected, of course, as well as looking at the VIX, so the volatility index, and then of course, then looking at equities as well, which we usually do. So some of the technicals around equities, with it also being the earnings season in the US and 55 companies reporting this week, no less. We'll then move on to last week's main event, which was, of course, the US CPI data. We'll just review that and look at the DXY chart before then moving on to this week. Just a a lighter week in the US, certainly, but there are various speeches from Fed officials to focus on, as well as Fed Chair Powell before the Fed blackout, in fact, before their meeting at the start of next month. And then we'll go into some other data around the world. We get UK data, quite important, potentially, for the Bank of England, so inflation and wage earnings, as well as looking at some other data around the world. As I said, there's Canadian CPI out and also the Australian jobs report out on Thursday. Okay, firstly, let's just check out, how markets are shaping up currently for the week. As I said, it's all about the Middle East events, of course. Markets remaining fairly cautious at the moment. Dollar is in focus, of course, kind of all nervously monitoring developments in Israel, in the Gaza Strip, certainly away from the humanitarian disaster, which potentially we are seeing. The focus is probably on whether there is also any escalation, be it from Israel's northern border with Lebanon, and also what, if anything, Iran plans to do or say, of course, when Israeli forces embark on this big ground offensive into the Gaza Strip, which looks likely very soon. It's worth pointing out the markets, of course, they do not have a great record of pricing geopolitical risk and assessing low probability, high impact events, or what we call tail risks. Studies show that economic activity and financial markets are often more affected by geopolitical threats than actual events. But equally, when there are several threats that are complex and hard to define, of course, markets can be stumped into inertia. So just to bear that in mind, just bear with me 1 second. I just want to focus on something. I'll just have a small issue, technical issue. Bear with me 1 second. Apologies about that, just a small technical issue my end. So, yes, I was just talking about sort of markets having quite a difficulty, quite issues, or not a great record really, with pricing in geopolitics, anything to do with that. It's highly uncertain, especially now at the moment. So there are issues around that, and of course we did see a knee-jerk reaction last Monday on the news over the weekend, but then we sort of reined that in somewhat through the week until Friday, where again we saw risk off come into the market, with people certainly not wanting to hold positions over the weekend. As I said, sort of risk off is the main idea around these sort of events. So that means we're constantly checking oil, gold, and then safe haven currencies. So in the FX space, we have seen the Swiss franc, for example, emerge as the strongest G10 currency over the last week. Of course, the yen as well as a haven currency, though that obviously has some or there is other factors, of course, involved in the yen at the moment, with dollar yen being very close to that 150 level. The dollar, of course, is a safe haven currency, and then you would get potentially selling in some of the other currencies like the Aussie and the Kiwi, so cyclical, more cyclical, high beta, higher risk currencies, if you like. So that's what we should be focusing on, we think, and then these themes potentially will dominate markets in a relatively, as I said, relatively quiet data week. I've got the gold chart up here. That gold spiked, 5.5% last week. The main drivers being, of course, as I've said, that safe haven buying and then short covering from speculators. And the risk really of a continued correction certainly remains, especially with ETF investors not showing any signs of involvement following months of selling. So that is something to look out for. If we just look at the technicals actually briefly, you can see this big jump on Friday, 3.4%, I think, in one day. Really big jump after those consecutive days of selling. We got to 1840, just below 1840, you can see, and so sort of near-term support just below there, around 1810 or so, just above there. 1840, is the halfway point you can see of the uptrend from November, those lows. So 1840 we got to 1810, as I say, and then this big move higher. Initially, you can see the sort of Monday move last Monday, as I said, knee-jerk reaction, but then we have carried on with that gold buying through the week, and then that big jump on Friday. We're now at the black line there, which is a 200-day moving average at 1929. And also you've got the 100-day moving average there just below 1922. If we do get above there, then you kind of think we'd aim for this sort of mid-September level at 1947. And then above that is sort of 1953, which is the September high. So really interesting, watching out for moves in gold. And then also, of course, looking at oil. So Brent still trades around $90. Let's just pull up that chart, actually. Bear with me 1 second. Yeah, just below $90 now. And you can see again, we jumped over 5% actually on Friday. That was its biggest daily percentage gain since April. Really, again, amid escalating tensions, and especially actually with Iran's foreign minister saying that others in the region were prepared to act. That was sort of contrary to what other nations had initially said as well. That was the big move on Friday. It is interesting. You can see just over the week where we did have that push higher on the Monday, but then we sort of fairly muted price action, really. Many traders, oil traders especially, believing the chance of a squeeze on supplies was unlikely. And if we just pull back, actually, you can see we're still way below the $97 seen in late September, when Saudi Arabia and Russia extended production cuts through to the end of this year. So really, there's no sort of massive pricing in of any sort of big escalation at the moment, aside from obviously this position adjustment on Friday. And this is obviously key, whether that move higher now can push up, say, towards 92.5 and then $95. This is in Brent, of course. Broadening of the conflict, as we said, that would change things. For example, if the US started strictly enforcing restrictions on Iranian oil exports, or if, say, there was a disruption in the Straits of Hormuz, which is obviously a big choke point, if you like, potentially. So all these things to bear in mind at the moment. As we said, it sort of was quite muted in oil, interestingly, until Friday. So again, something to watch out for there. Also, I said we look at the VIX. So this is Wall Street's fear gauge, if you like, volatility index, showing basically prices of the S&P 500 options out for 30 days. Long-term average is around 17, I think 18 or so. If I just pull back, you can see where we do sort of spike high. You can see obviously pandemic highs above 80, and then we have periods of sort of sharp, relatively short spikes. You can see where we shoot up to sort of near 40 or so. That is very high, really. You can see doesn't happen too often, but it can do. And at the moment, well, long-term average, as I say, is around 17. We've been oscillating for some time. You can see below that level, really interesting, really low volatility or levels of volatility until then we've picked up most recently, pushed up above 17 and above 20 actually at one point, ending around 1930, I think 19.3 anyway. Well, and there's an expected move then for this week in the S&P around 83 pips, so about 2%, just under 2%. So NASDAQ a touch more of volatility, sort of measuring that for the week is around above 2%, 2.14%. So potential volatility ahead, and the VIX picking up here. If we do move above 20, then just beware of that, of course, for stocks. Otherwise, as I mentioned, we do have Q3 earnings really heating up now. 55 companies, I said, in the S&P releasing their reports over this week. More financials will figure prominently, of course, or certainly, and they account for about half of the total number of releases this week. So that includes names like Bank of America, Goldman Sachs, Boney, so that's Bank of New York, Mellon, Morgan Stanley, State Street, and Amex. And then we get sort of the really well-known stocks, Netflix and Tesla are among the other names reporting. Focus will be on the electric vehicle makers' margins as the price war in the EV market continues. Revenue is expected to fall modestly from Q2, while profit is forecast to come in around 77 cents a share. Regarding Netflix, the streaming industry is having to contend with the impact of the strikes by writers and actors. Probably may not affect the earnings just yet, but Netflix expected to report revenue of $8.5 billion and a similar rise in new subscribers to the previous quarter. So markets potentially going to focus on those subscriber numbers as they always do. Profit is predicted to hit $3.52 a share. Okay, just looking at some of the wider indices, we can just see, yeah, stocks fell on Friday. S&P down 0.5%, NASDAQ down over 1%. Big tech really led the sell-off on really, again, concerns about the widening conflict. Could then potentially drive up oil prices further than what we've seen. And of course, then tip the global economy into a recession. We can just see on the S&P 500, just go to the weekly. You can see we're tapping this long-term trendline support, still holding, has held for a few weeks now. So potentially that looks good. Otherwise, if we do drop down below probably 42.16, then we're getting towards, we mentioned before, 4,200, quite a big area zone of support. Oops, sorry, here's the daily. It's got a few dotted lines here. Don't always want to complicate things too much just because I've got a couple of wider fib levels in there. There is a long-term fib level at 41.81. Otherwise, if we take that one out, you can see this is a shorter term, well, yeah, fib level with a half. Yeah, the halfway point of this this move from the March lows. So the rally, really, the halfway point of that is around 4,200. You can see 42.11 bounced off there, and also the 200-day moving average didn't quite touch it actually, but that's at 42.21 now. So rising, even though we just rolled over, of course, on Friday. Interesting though that stocks were marginally higher on the week. If I just show you this, yeah, they're up just under 0.5% on the week, with obviously the week with all the geopolitical tensions. Nasdaq didn't do so well. That said, you can see it did close higher on the week again, so just bear that in mind, of course. And we're just tapping now this that trend line. Just about, yeah, I mean, if I extend it, you can see we're sort of trading above, below it, and now we're still above it just about. Futures pretty flat, you can see in the Nasdaq there. So it'd be interesting whether we can hold this sort of trend line support. And then we've also got the 50-day and the 100-day moving averages just above 15,000. So that'll be your first level of support or resistance even. No, I'm just checking. Futures are well just above 15,000, so that'll be probably initial support, as I say. Before then, potentially, if we do not hold prices, then we get back to this sort of these levels around sort of 40,500, just above. That is the Nasdaq. Just on the Dow, again, we've got 34,281. I'm sure you all know that level that I stick to still. We did break down below it, but we're still holding on to the 100-day moving average now at 33,458. And then just above there is the 50-day moving average at 33,787. Okay, let's move on now to last week's main event, which was first of all, the US CPI, of course, which you can see here. Just got a graphic really just showing the main numbers. The data, yeah, close to expectations, though a touch higher. So the headline CPI came in at 0.4% month on month. The year on year, 3.7%. That was against consensus having 0.3 month on month estimate and 3.6% year on year. So a touch higher in the headline. Core inflation eased to 0.3% month on month, and then 4.1% year on year. That was pretty much as expected, and down from the 4.3%. So yeah, just really the headline which sort of grabbed the attention in a way. The fact is CPI course still remains far above the 2% inflation target. Housing, in amongst the details here, housing is still running hot at 0.6% month on month. But as we have said before, actually, there is a lag with that data impacting on the CPI figures, and that should come through in the coming months. The other key number for the Fed especially is the sort of super core rate. That is basically services, X shelter and X energy. And that's sort of primarily driven by wage pressures in the still pretty much tight job market. So those the super core rate that rose 0.6% still month on month. So worth keeping that in mind, as I say, certainly because policymakers are very focused on that figure. Also, we've sort of talked about this 0.3 sort of 0.2 number really being in the core month on month as a wider sort of gauge. 0.2 generally recognized as what we need to bring down inflation to target. So sort of just this move up in towards sort of 0.3 means really the battle kind of hasn't been won yet about bringing, as I say, CPI back to target, and certainly closer to target. I just show you here this is the core on a couple of different charts, if you like. The blue bar chart there is just the month on month, and you can see the just below 0.2 readings, and then we had that sort of 0.278, I think it was, to a few decimal places there, so a touch below 0.3 last month, but then now we're just a touch above 0.3 actually. So whether, interestingly, this was a sort of soft patch which we have seen previously since the pandemic. I think three different times we've seen this sort of softness in prices, and then we've moved higher. So just something to bear in mind again. You can see the 3-month annualized core number just ticking up now, whereas the year-on-year figure is declining. So it's just whether, as I say, these shorter indicators really pointed to potentially prices moving higher. We shall see, of course, going forward. Otherwise, really interesting that we have had just in the US, of course, all these Fed comments last week, especially from Logan, known as generally a hawk, and Vice Chair Jefferson as well, really saying that the recent rise in bond yields, long-term real bond yields, have caused a similar tightening equal to, say, a final 25 basis point Fed hike. So that really suggests that the surge in Treasury yields since the Fed last met has done the work for them. And then that implies, of course, that another hike before the end of the year may not be needed. And this was sort of a real focus last week, will be interesting this week certainly as well. Although that said, of course, the CPI sort of changed the dynamics slightly, and markets really pushed that aside, the assessment, certainly from Logan, with yields rebounding somewhat after the CPI data. Yes, as I say, so it will be interesting with Fed comms, Fed communication going forward now, the higher for longer sort of rates theme being a potential substitute for Fed rate hikes, apparently isn't that evident for markets to cope with. So maybe the market concluded, well, this is after the CPI data, of course, that the Fed may have more work to do. But the pricing, yeah, it kind of is difficult to sometimes to ascertain exactly the factors pushing prices in the last few days anyway, because of these as well Middle East tensions that we have seen. Also last week, just touched on the University of Michigan Consumer Sentiment Survey. That was on Friday. Kind of interesting reading because there was a sharp decline in confidence in the October reading, but with both actually the current conditions and expectations falling. But there was a steep pickup, in both the 1 year and 5 year inflation expectation surveys. So that is something to bear in mind. Again, kind of not a game changer at the moment, but inflation expectations are something all central banks take very seriously. And if, of course, these figures were sort of backed up by other indicators of inflation expectations, then that might just put rate hikes back on the table. Let me just show you, I'm just going to want to show you just the CME, just to show you. So this is the CME Fed Watch Tool. I always like to go to this, but again, you can see where markets are pricing in, or what markets are pricing in for the next Fed meeting. So that the next one on the 1st of November, very little chance of a hike, of course, less than 10%. You can see, and then we get to December, and there's around a sort of 33% chance and a 1 in 3% chance that the Fed hike rates by 25 basis points at the December meeting. If we go beyond that, then really we're getting into sort of, well, not cuts, but the higher for longer phase, before then cuts sort of towards the middle and third quarter of next year. As for this week, let's just pull up the DXY chart. Just bear with me 1 second. I'll just with me. Yeah, here's the DXY chart. So that's the weekly. You can see that consecutive numbers of weeks of gains that we talked about. It's very rare for major currencies to do that, and we just sort of did slow up, but very marginally, you can see. And then we pushed on again last week. Moving on to this week, well, sorry, just to sort of clarify that, of course, yeah, we did push up higher last week in the dollar, mainly on the back of the Haven bid. But again, we want to reiterate those slightly dovish remarks from Fed officials, changing the tune slightly, should we say, over what we have seen, just because of this big rise in bond yields. So this week we do get more Fed speeches. Relatively quiet week for data, as I said. Several officials scheduled to speak, and then the highlight will be Fed Chair Powell's speech on Thursday. That comes, as I said, before the blackout starts on the weekend, ahead of then the FOMC meeting on November 1st. And certainly it will be interesting to hear what officials say now in the aftermath of course, those latest inflation numbers. Tuesday, I should say, tomorrow we do get retail sales out of the US. So headline and core actually for September forecast to have slowed to 0.2% month on month and 0.1%. That's for headline and core, respectively, after both growing by 0.6% in August. So that may temper some dollar buying for sure. And then we do get as well industrial production, which is expected to have decelerated. That's kind of mainly all the data out of the US. There is some housing data as well. But if we just look at the chart, then you can see, we've kept in this bull channel here, series of higher highs, higher lows from the sort of summer lows. You can see we dipped out of this channel, but I've kept it in there because then this big move higher after CPI, and we're just sort of now, just sort of quite quiet, but just slightly lower this morning, at least, to kick off the week. We did, so the rally did pause at that halfway point of, let me just show you, of the decline from the sort of October, November highs. So that moved down here. The halfway point of that is at 107.17 that you can see there. So we tapped that, but couldn't close above it. And then we pulled back into the channel now. We're sort of still in that channel with, I guess, these lows here now being most important around 106.40 or so. And then the 107.17 potentially holding as resistance for prices above. That's on the DXY. Okay, let's now move on to this week, and the main data for this week will be, well, firstly, there is data out of the UK. I'll just pull up a graphic actually, so bear with me 1 second. The chart actually of UK CPI, quite an important week really for sterling. As I said, we've got CPI data and also jobs and wages. That's released tomorrow, CPI on Wednesday. Sterling kind of a bit of a sideshow at the moment, obviously given the events in the Middle East, and then also whether all this Fed speak is potentially, the Fed are embarking on a somewhat less hawkish narrative going forward. Back to the UK, though, wage growth is first up. That's on Tuesday. Still likely to continue causing headaches for the Bank of England, given that for the last 2 months, it's been trending at a record high of 7.8%. And then with the addition of one-off bonuses, actually, the actual number is well above 8%. So it seems really it will take some time for the cumulative effect of the rate hikes of the last few months to be felt fully. This means that while rates may not need to rise further, they may need to stay higher for longer. And then the prospect of a rate cut, really, we probably won't be seeing in the UK before probably the second half of next year. That's sort of current consensus. Latest ILO unemployment figures, they are expected to increase modestly to 4.3% from 4.2%. But it's the wage growth numbers which will be important. You can see here how high they are, really quite interesting. And then we've also put on there the core CPI number. Inflation out on Wednesday, as I said, the headline expected to fall to 6.5% from 6.7%. Remember that the prior report acted as a really decisive factor in the Bank of England's decision to stand pat on rates in September. That was after the release saw declines in the headline, the core and also services CPI, which again is what the MPC members look at closely. The latter, that figure actually coming in at 6.8% for services CPI, and that was actually well below the Bank of England forecast of 7.2%. So for this release, economists really think that despite the push higher in fuel prices over the month, inflation should continue its downward trend in September. There'll probably be upward or upside pressures from education and transport, but these will probably be outweighed by easing price pressures in areas like food and clothing. So from a policy perspective, markets really still not completely written off the view that the Bank of England has one more hike in it, really. I think there's around 15, 16 basis points of further tightening priced in by money markets. So that's kind of above a 60% chance of a hike by March next year. And certainly this week's data should play potentially quite a big role in determining whether then the Bank of England do possibly change their stance or even hike on November 2nd. So that's a day, don't forget, after the Fed meeting. But the odds of that are quite low at below 20% at the moment. And certainly this recent upside we've seen in yields, further tightening financial conditions will be important as well for the Bank of England. So basically, yeah, we probably need to see much stronger than expected reports in these, well, in wages, in inflation, and also we get UK retail sales Friday, really to shift the dial, because just remember the Bank of England didn't hike last time, and that kind of means now the bar is probably very high for a change in this bias. Although, of course, let's not forget it was a very close vote, 5-4. So that's UK CPI. I'll just pull up a cable chart now, actually. So that is dollar against the pound. Just 1 second. Which is this chart here. Yeah, tough environment at the moment for sterling. And a good one really for the dollar at the moment, of course. We did get a few days of sort of gains the sort of through last week, actually, kind of position adjustments and bargain hunting probably, because it wasn't really any fundamentals in the UK for sure. But you can see then couldn't get above a sort of resistance zone. Now it looks like around 123.37, 123.31, and then you can see again another channel working quite well, really, bear channel this time, of course. So we got towards the top of the channel, and then we pushed lower, of course, on Thursday after the CPI data, and we're now very much in the middle of the channel and potentially moving lower if we do beat Friday's low at 121.22. If that happens, then it looks very likely we go down to sort of 120.37, which is the recent cycle low there, with the bottom of the channel then being below 120, you can see. Definitely the data, though, for sure will have an effect on sterling, although again, just bear in mind the wider sort of geopolitical environment that we are in at the moment. Okay, we'll move on to dollar CAD now. We also get Canadian CPI numbers out tomorrow. Just remember at the September policy meeting, the Bank of Canada, they kept rates unchanged, but then officials were concerned about ongoing and broad-based inflation pressures. And really some of the components were rising still well above pre-pandemic averages. And actually, the Bank of Canada, at the September meeting, they noted that shelter costs and high oil prices were contributing to inflation. So they will closely monitor whether the momentum in underlying inflation is decreasing, particularly focusing on core inflation, which has remained sticky. But they are certainly prepared to raise rates if needed. Just on pricing then for the Bank of Canada, investors really kind of not expecting much to happen at its upcoming meeting on October 25th. That is next week. Signing really only around a 20% probability of a 25 basis point hike, while the chances of another hike by March kind of around 50-50. So data will be important for the Bank of Canada, as I just stressed. And even if markets aren't convinced that another hike may be warranted, then certainly CPI numbers, as I've said, will be important for policymakers. And potentially, if we do get a strong report, they may help the loonie going forward and recover some lost ground against the greenback. You can see the dollar CAD chart here. Well, the loonie actually, so the Canadian dollar gave back all of its gains it made at the start of last week, and really in an alignment of trend momentum signals in favor of the dollar suggests that, well, potentially we could see dollar CAD retaining a firmer bias in the near term. It's not quite happening over the last 2 days at least, but broader price patterns do probably suggest resistance around sort of 137 and just below. And I've got the high from, you can see, April. That's at 136.67 there, and it has sort of capped prices a few times since March. So we're watching that and sort of the bigger, sort of wider area around 137 as well. If we do roll over, then probably near-term support around this sort of 50-day moving average, which is moving higher, 135.57, and you can see the lows, recent lows were at 135.69. So that would be initial support in dollar CAD. Okay, finally, let's move on to Aussie dollar and the Aussie jobs report. Just before that, actually, the RBA does release its minutes from its last meeting, where officials kept interest rates untouched for the 5th consecutive month, but added that some further tightening may be required. But otherwise, jobs report is released on Thursday. Currently no forecasts, but I think there's analysts at a local investment bank see the employment change at 20,000. That's from previous 64,900 job gains. Remember, a lot of those were temporary. So that's something to bear in mind with this slower pace. Unemployment rate set to probably remain steady at 3.7%. The data has sort of had a choppy feel to it over the last 2 months, probably a reflection of shifting seasonalities. And then businesses have demonstrated a kind of remarkable ability to absorb the migration-driven surge in labor supply, although this dynamic will be tested as the broader economy continues to slow. Probably likely, though, that we've seen, the labor market has moved past its tightest point. That is something to bear in mind, but then slackening to a material degree will probably take longer and will probably remain tight into year end before then that sort of degree of slackening emerges next year. That's the concern for the RBA and for policymakers. At the moment, concerning the bank, there's probably above an 80% probability that they remain sidelined again for a 6th consecutive time in November. But there is a decent sort of above 50% chance of another rate hike by May 2024. As for the Aussie, you can see it struggled recently. We moved out of that 66, 68 range and sort of establishing, looked like a sort of 64 just below and a 65 range, but then we've just moved lower. We didn't quite make new lows on Friday, actually, so that's interesting with this risk-off move that we saw. So that is now sort of very strong support around 62.85, 62.86. Very strong support around there, and we're just bouncing off there today. So really interesting whether that holds. If we just pull it out a touch, you can see if we do lose that, then we've probably got support then around the October 62.72. October lows from last year. 62.72. And then otherwise you have this real long-term low at 61.69. That is the Aussie dollar. Okay, really good to have you guys on the call today. Hope that's been of use to you guys. Obviously, it's a volatile time out there. Lots of headlines, lots of headlines to digest, really, on the Middle East events, of course. But as I said, bear in mind just knee-jerk reactions, as well as then potentially looking at some of those assets, gold, oil, and the currencies, safe haven currencies, or potentially not. So whether fears recede and sort of risk taking becomes slightly more evident, I guess. Great to have you. As I say, I think our next webinar is actually next Tuesday, so not next Monday, next Tuesday. But really good to have you. Please do follow us on social media, and we shall speak to you next time.